So what I'm going to do today is break down a little bit of the tiers of different types of lenders that your mortgage broker will be able to work with you on. We're going to start with A lenders, talk about B lenders, C, private money. How do we use this to acquire properties, and how do we use this on the back end to exit from the private money or the higher interest money? How's it going, everybody? My name is Kyle Ford. We're going to show you guys today what I like to call the mortgage map. When it comes to real estate investing, we hear so much about, acquire with private money, but how do we do that? How does that look like? And how do I exit the private money? So what I'm going to do today is break down a little bit of the tiers of different types of lenders that your mortgage broker will be able to work with you on. We're going to start with A lenders, talk about B lenders, C, private money. How do we use this to acquire properties, and how do we use this on the back end to exit from the private money or the higher interest money? So I'm going to start with what everybody's familiar with, A lenders. So the holy grail in A lending is income. So everything that they want to see needs to be verified. Verified. You don't need to be an excellent speller or writer to be a mortgage broker, just so you know. So income needs to be verified. This means your bank or your broker is basically going to give you a document enema. They want to see your 2 years taxes, blood, urine, mortgage statements, leases, the whole nine. Now, we often hear that the banks only use 50% rental income. Partially true. We're going to talk about that a little bit more. So this is where people run into challenge with scaling. They buy a condo, the bank cuts their income in half. Now they can't get their second, third, or fourth mortgage. So for the number one thing that A lenders care about is income. Next is credit. You got to have a score above 680. Some scenarios below 680 you can get an exception, but for the most part 680 Beacon score is required. The next is down payment. If you're going to live in the investment property or property, it's between 5 and 19.9%. So that's OO, owner occupied, or if it's going to be an investment property, 20% down for a rental. Final is condition. The A lenders want to make sure the property is habitable. What that means, so I'm going to say habitable. I think I spelled that wrong, but habitable. So that means the day you buy the property, there needs to be a verified heat source. The next morning when you wake up or your tenant wakes up, they should be able to take a shower, use the toilet, cook themselves breakfast. If they can't do these things, the property's not deemed habitable, and an A lender's not going to touch it. Best interest rates. You're typically paying between about 3 to 4% for an A lender. Lower threes right now. And there's also no lender fees and no broker fees. Okay, so once again, because they put you through the ringer here, this is the lowest interest rates. This is also the least restrictive and the most slow. So the next tier I want to talk about is a B lender. When it comes to income on a B lender, they use what's called stated income. So if you're a new contractor and you've been in business for 6 months, if you can show consistent bank statements showing the money coming in to your bank account, they'll gross that up for a year and allow you to use that as your income. They'll also do up to 100% rental offsets. So if you have rental income on what's called a non-subject property, so you're buying a property which is the subject property, and you have another rental, instead of taking the 50% cutoff, these B lenders will use 100%. So they can essentially wash that property, take it off the application, and use your income to qualify for the next property. With B lenders, credit can be as low as 500. They're probably going to want a little bit of a story to explain why your credit is in that shape, and the better the credit, the better the pricing, which we'll talk about down here. With B lenders, down payment is 20% down, and the condition of the property must be habitable. It also must be marketable. So what that means is it needs to be in an area, they don't generally like to go out into the boonies. Kapuskasing, Ontario probably isn't going to happen, but if you're in major markets, most B lenders are going to be comfortable, but once again, very important that the property is in good, habitable, marketable condition. When it comes to B lending, in terms of interest rates, between 4 and 6%. So if you have high credit and it's going to be your own your primary residence, you're probably going to be closer to the 4%. If you have low credit and it's going to be a rental property, maybe closer to the 6%. Also in this scenario, you're typically paying about 1 to 3% in fees up front between the broker and the lender. Essentially, the B lenders don't compensate the broker as much for the amount of work, so you need to pay the broker a little bit of a fee. They also charge a little bit of an administrative underwriting fee up front. So that's B lending. Next is C lending. I like to put a little bit of a question mark here in the income line. Let's talk about it. How do you make your income? How are you going to service the debt? They might ask for some documents. They're probably going to ask for a couple bank statements, but not nearly as scrutinized as a B lender. Credit, probably above 500. Once again, put another question mark. Let's talk about it. Let's talk about what your credit is, what your situation is. Down payment, some B lenders will go as low as 15% down. They are generally pretty concerned about the condition and market habitability of the property. In terms of pricing here, these are equity lenders. They're not as concerned about your personal situation. They're typically charging between 6 and 8% with a 2 to 4% fee. These are a great lender to have up your sleeve, but for the most part, most investors I know right now are acquiring in this line right here, which is private financing. A private lender is not concerned about your income. They're generally not as concerned about your credit. They might ask a question or two on it to make sure you're not a deadbeat, but they're not, in most scenarios, aren't asking for a credit report. Down payment can be as little as zero money down. For the most part, I like to tell people 10% down, or 10% in equity. So I'll tell you a little story on that one. One of the first flips I ever did was in New Hamburg, Ontario. It was a property that was gutted down to the studs. So it was not marketable, or not habitable, and relatively marketable. But that property I purchased for $231,000. On purchase, it appraised for $271,000. So what that meant is I had over 10% equity in the deal. My lender lent me 100% of that purchase price. So even though I didn't actually put the 10% down, I already had money in the buy. I made money on the buy. So this is private lending. Generally, you're between 8 and 15% in terms of interest rate, and 2 to 4% on fees. Now, why are we acquiring, essentially the strategy that most investors I know today are using is they're acquiring down here. What they're doing is 6 months or less on the private side, acquiring, paying 12% interest, paying a 2% fee to acquire the property. And now they're going up the ladder on the refinance to go to the best property that they possibly could. A question I get a lot is, well, why wouldn't I just start with a B lender if it's at 4% instead of a private lender? Well, maybe you're doing a duplex conversion. So you're buying a single family home that only has one rental income that doesn't meet the DCR qualifications that A and B lenders will look at. That stands for debt coverage ratio. So essentially, you go in, you buy the single family bungalow, you add a basement apartment to it, you fully renovate it using private financing. Now you have 2 leases at top market rent, and you go back to that lender that you no longer qualified for on the B or the A side, and you have a fully renovated property at top market value with 2 brand new leases. Now you're in a position where you could exit that property with a B or an A lender. So this is what I like to call the mortgage map. This is how the pros I know are doing it right now. They're getting creative on the financing. They're not focused on the interest rate, but they're focused on the ease of acquisition. And then on the back end, 6 months or less, they're moving up to the best available lending.